You were short Tesla going into yesterday's earnings report. What were you thinking?
Today, there's no other stock more popular and controversial than Tesla. In this video, I really wanted to break down the company and really show you guys what the company is about. I'm gonna answer questions like, is Tesla really a good company to buy and at what price? To start off, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning.
Of every possible way I could think of to power a car. And it was a surprise to me to discover that the electric car was by far the most efficient way that we could power a car compared to everything else.
But the story really began in 2008 when Elon Musk took over as CEO. Musk really took this company from hell and back and really changed the way the automobile industry works.
What the Roadster's greatest value is in breaking the misconceptions around electric cars, showing that you can have a fast, cool, beautiful electric car that goes long distances.
Basically, he wanted to show the world his version of the electric vehicle through Tesla. Tesla itself is actually much more complicated than just an auto company. If you really think about it, at the most basic level, if we peel all the layers off, Tesla's actually a battery company. The company sells electric vehicles, which are pretty much batteries attached to wheels, solar roof, and also solar panel, which are also attached to batteries. Nevertheless, the company generates 80% of its revenue from just selling cars, and that's why most people think of Tesla as an auto company. In fact, Tesla has only recently become a true auto manufacturer. Before 2018, the company has only managed to manufacture between 20 to 40,000 cars per year, which is a fraction compared to companies like GM who manufacture more than 5 million cars per year. When Tesla finally managed to build 5,000 cars during a period of 7 days, Elon Musk actually quoted, "I think the company has just become a real car company."
The company was bleeding money like crazy, and just if we didn't solve these problems in a very short period of time, we would die.
Today, the company continues to push for more infrastructure by building more plants and equipments. The company initially started with its California factory in 2010, which still currently builds 70% of all Tesla cars. After this factory, the company really pushed the limits on what could be done and created gigafactories. And these football field-sized gigafactories are truly something else. They house around 7,000 employees creating battery packs and electric cars. The company built the Nevada Gigafactory in 2016 and also the New York Gigafactory in 2017, which still only produces solar panel, solar roof, and also Powerwall. More recently, the company built a Shanghai factory in 2019 and also planned to build a fourth one in Germany and also a fifth one in Texas. In the first 3 months of 2020, the company produced about 102,000 cars and sold 80,000 cars. The company has actually managed to double its production capacity in just 2 years, and this number is likely to increase in the future as more factories are being built and the production process become more efficient. With everything we talked about so far, we can see that Tesla really makes money from each car it sells. And the company made about $54,000 for each car it sold in 2020. And this is really what drives revenue for Tesla. However, the question you really want to ask is, can Tesla really keep this up? And can it really compete with other car manufacturers who have controlled this industry for decades? So the first thing you really want to remember about Tesla is that it's both an auto manufacturer and also a battery technology company.
Next quarter at the Gigafactory, we expect to make more battery capacity than all other EVs combined worldwide, including China.
And when you really stop to think about it, this is really what gives Tesla its comparative advantage in the market. Because building electric cars is much more different than building traditional cars. Traditional car manufacturers might be great at building engines, but that doesn't necessarily translate over to electric cars. For example, to build an electric car, you need the right people and also the infrastructure in place. You need the people to design the software, and also you need the infrastructure to really produce a battery and also the electronics. Basically, traditional automakers don't really have the infrastructure, equipment, or people in place to really build great electric cars, and it really shows. For instance, the biggest competitor against Tesla's Model 3 today include the Nissan Leaf, the BMW i3, and also the Chevrolet Bolt. These other electric vehicles actually have lower top speeds, a lower 0 to 60 time, less mile per gallon equivalent, and also less range. In addition to all these things, they also don't have autopilot, which is really a standout feature from Tesla cars. For these companies to realistically build a better product than Tesla, they're gonna have to spend billions of dollars in research and development. In addition to this, these automakers now have to hire the right people from Silicon Valley and also set up the right infrastructure in place. And if you really think about it, this represents a huge risk for these automakers.
And so every other auto manufacturer will, if they want to be competitive with Tesla, they will have to sell their cars at a loss. At the same time, they are losing their internal combustion engine business.
Many of these companies are mature companies who just want to maintain their dividend dividend and keep their investors happy. Basically, they want to continue to do business like they have in the past. Even if these big automakers really do want to make changes in the business, now they're going to have to wait because of the virus. It's likely that most of these companies are really going to have to shift their focus towards cutting costs and really surviving this pandemic. To really give you guys some context, the auto industry has thin margins and really rely on production at a massive scale to make some sort of revenue. And this makes it really hard for automakers to not go bankrupt, because a slight decline in demand can really set off a chain reaction and put these companies into bankruptcy. In fact, the only two American automakers that haven't gone bankrupt is Tesla and Ford. In addition to traditional automakers, newer EV companies will also face a challenge competing against Tesla. You have to understand that being able to build electric vehicle at scale requires a lot of capital. Between 2015 and 2019, Tesla actually raised about $12 billion to really get to where it is today. This really represents a huge barrier of entry for a lot of companies who really want to get into the EV market. In fact, the founders of Tesla knew this, and that's one of the biggest reasons why the company decided to produce a limited number of really high-end electric vehicles when the company first started. Many startups simply don't have the production capacity to really churn out Model 3s at scale.
How much more has the project cost than you thought it was going to cost?
Probably twice as much.
Therefore, many of these new EV companies are going to follow a similar formula, and it's going to take a lot of time and effort for these companies to really compete against Tesla. And that's not even mentioning how hard this process really is, and many companies are really going to run out of money before any of this happens. For example, Faraday Futures, an electrical car company from California, is currently cash-strapped, and the owner is actually going through bankruptcy. And another company that's currently in a lot of financial trouble is actually NIO, an electric vehicle company based in Shanghai. The company is currently cash-strapped, and it needs to secure a lot more funding in order to remain in operation for the long term. Lastly, there's also one more popular electric vehicle company called Rivian, which focuses on producing SUV, pickup trucks, and also vans for consumers and also businesses. However, this company is still in the process of figuring itself out, and it's going to take a long time before it catches up to Tesla. Therefore, what we can really get out of this is that many of these companies are just hype, and they're not going to be able to realistically challenge Tesla. In fact, Tesla's technology and infrastructure is simply years ahead of these companies. And in order for a lot of these electric vehicle companies to truly compete with Tesla, they're going to have to come up with a better product. So you might be thinking, what makes Tesla cars better than other cars? Tesla actually spends about $1 billion each year on research and development, and this really led to 5 main things why Tesla cars are better than traditional and also other EV cars. The first thing you want to know is that Tesla motors are actually a lot more cheaper and efficient than other electric motors. Tesla cars have a better range because of these motors, and they're a lot cheaper too. For example, Tesla motors actually only cost $754 to produce, but motors from BMW cost $841 to produce, and motors from Chevy cost $836 to produce. The next thing I want to mention is that Tesla has better battery technology compared to its competitors. The company can save costs by producing these batteries at scale through its gigafactories. And these batteries allow Tesla cars to hit 350 miles on a single charge, while other cars can barely hit 200. More recently, the company actually aims to really improve the functionality of its batteries, and it wants to build a battery pack that can last 1,000,000 miles. This is really important because the average car lasts about 175,000 miles. The next thing that really makes Tesla products superior is really their network of EV charging stations. The company currently has about 14,000 stations around the world, which makes up 57% of all charging stations available. In addition to this, Tesla actually owns their charging stations as opposed to other companies who lease them from third parties. And when you put all this information together, you can see that Tesla products are actually much easier to use for consumers. The fourth thing I want to mention is that Tesla actually designed its own self-driving computers and chips, and the company has a lot of data. The company already has about 400,000 cars on the road collecting data, while its competitors have less than 1,000 cars. This basically allowed the company to log in over 1 billion miles on autopilot. The more data that the company collects, the better their self-driving cars will be. And this pretty much positions the company as the leader of self-driving vehicles in the future. And this is one of the biggest reasons why Uber is not going to be the first car to really come up with an autonomous taxi fleet. And make sure to check out my analysis on Uber to learn more about the company. The last thing I want to mention about Tesla cars is that they receive regular updates just like an app, and this pretty much means that your car gets better over time, and each update fixes some sort of troubleshooting issue and also upgrades a car. I think this is actually one of the coolest things ever, because the longer you own a Tesla car, the better the car gets, and that's pretty much different from what we see in traditional cars. Thus, with everything we know so far, Tesla pretty much has a better product than any competitor, and the company today continues to try to improve its product line. In 2020, the product line includes the Model S, which is a high-end sedan at $79,000. The company also has a high-end SUV called the Model X at $84,000. Lastly, the company sells the Model 3, which is a mid-tier sedan at $40,000. More recently, the company rolled out its Model Y, which is a mid-tier crossover at $53,000. We can also expect to see the Roadster, which is a sports vehicle, at $250,000 later this year. In 2021, the company will release its Cybertruck, a mid-tier pickup truck, at $40,000. The company will also target businesses that year with their Tesla semi-truck at $150,000. Basically, what we can see here is Tesla's really trying to build a complete product line. Currently, the company has a high-end SUV and sedan, as well as a mid-tier sedan. And very soon, the company is going to be able to add a mid-tier crossover truck and also hit businesses with the semi. And with each new product line, Tesla's revenue has been growing at an exponential rate since 2016. We can actually see that Tesla's revenue went from under $1 billion in the first quarter of 2016 to about $5 billion in the first quarter of 2020. We can also break down the revenue from Tesla to really figure out who the customers are. When the company only had its high-end Model S and XL, the buyers tend to be over the age of 45 with over $100,000 in income. However, when the company finally released its mid-tier Model 3, this pretty much changed everything. The average consumer now is between the age of 35 and 45, and the average income is actually between $50,000 to $100,000. And the company just doesn't want to stop there, because their goal is to really build an affordable car for the average American, because that's really the best way for the company to expand. Based on this, we can see that Tesla's future goals are pretty much to make electric vehicles more affordable for the average person. And this is likely what's going to happen in the future as economy of scales get better for Tesla and also the cost of battery decreases. We can actually see the increase in research and development costs led by Tesla. Research and development expenses has increased from about $200 million in 2010 to about $1.3 billion in 2019. This is really because the company relies on word of mouth and really lets a product speak for itself. For example, Elon Musk has actually stated that brand is just perception, and perception will match reality over time. Therefore, I think the company's plan to grow domestically is pretty much a matter of improving its products over time and really letting word of mouth to really take care of the rest. And I think this is going to be the same strategy that the company is going to use in international markets as well. When we actually talk about international markets, the demand for electric vehicles is actually growing in every country. China is actually the fastest growing EV market in the world right now. The country buys about 1.2 million electric vehicles each year, which is 4 times that of the United States.
Continue making a significant investment and increasing the investment in China, making the Model 3 and the Model Y and future models also in China.
Before the year 2018, the government pretty much refused to allow foreign automakers into the market. They pretty much set up complex regulations and really forced all these companies to pay about 50% of their profits to the government. However, the Chinese government made a calculated play to let Tesla into the market. Tesla became the first company to build a plant in China since 2018, when more relaxed laws allow foreign companies to operate without much oversight. This pretty much meant that Tesla didn't have to share its profits. It also meant that Tesla has fair access into China's population of 1.4 billion people. From all this, you might be thinking, why is the Chinese government so accommodating towards Tesla? And the truth of the matter is that China has a lot to gain from this relationship. To really start off, the Shanghai plant is pretty much funded by Chinese banks. These banks lent Tesla $1.6 billion, and many of these banks can expect a good profit from the construction of the Gigafactory. The next thing that you should know is that the factory will create more local jobs, pretty much boosting the economy in the future. Moreover, Tesla has also promised to build research and development facilities in China. These facilities have to be filled with domestic talent, and this is really going to help China step up its EV game. Lastly, 100% of the parts are expected to be sourced locally from Chinese companies by the year 2021. This is going to mean big business for a lot of Chinese manufacturers. Basically, by allowing Tesla into China, China is going to be able to get access to Tesla's technology and also grow economically. Likewise, Tesla also has a lot to gain from this transaction. Like I mentioned earlier, the company now has access to China's population of 1.4 billion people. In addition to this, the company now bypasses any sort of economic damage from the trade war. And lastly, the company now has access to cheaper labor in China with less workers' regulation. The company actually did about $3 billion in revenue just from China in 2019, and that number is expected to increase exponentially in the long term. Basically, what we see here is a mutually beneficial relationship between the Chinese government and Tesla. And this is really another reason why Uber failed in China, whereas Tesla succeeded. China simply didn't have anything to gain from letting Uber into the market. In addition to just China, Tesla plans to expand into Germany as well. German automakers employ about 1 million people and represent 5% of the economy. A gigafactory in Germany will help the country preserve its status as an automaker in the future. And it's also going to help Tesla expand its market share in the European markets. The truth of the matter is that in the short term, the stock market is pretty much like a voting machine. Individuals make the decision to ultimately sell or buy, which determines price, but it doesn't determine value. And value is really what drives price in the next 10 years or 5 years for a stock. Moreover, Tesla has been a really popular stock for a lot of speculators. This is especially true in the early days where large-scale production for Tesla almost seemed impossible. Whenever a stock has a lot of speculators, this really means that the stock is more volatile than other stocks, and the price of Tesla can drop or increase by hundreds of dollars in a single day. The key to understanding Tesla is to know that volatility doesn't necessarily translate to riskiness. Each stock in the stock market moves differently, and Tesla definitely has its own behaviors and patterns. And that pattern and behavior is no way related to a stock's long-term value. Instead, long-term value is really determined by the business model and also the fundamentals of a company. So how does the fundamentals of Tesla actually look? On the income statement, we can actually see that Tesla has a net loss for the year. And a net loss is basically a negative net income. However, as somebody who's worked as a financial auditor, I can tell you that this is actually not that big of a deal. I'm not going to go through all the details, but basically net income is not a real number. It's a number that's created under GAAP or generally accepted accounting principles. And this number can be really different from reality because it includes things like depreciation, amortization, and also timing differences. Nevertheless, I think it's a really important number to look at to understand the company better, but what's more important is actually the cash flow of the company itself. You can't really financially engineer the cash flow of a company because what comes in is what comes in and what goes out is really what goes out. Therefore, I really love looking at the cash flow statement of a company to really see if it's making money. And we can actually see that Tesla's core business or its car business is actually generating cash, and it's been generating cash since 2018. In fact, in 2019, the company generated about $2.4 billion in cash from its main business. In addition to this, the company also spent about $1.4 billion on expanding the business itself. I really love seeing this because this means that revenue is likely to grow in the future and also the stock price as well. When we take a look at debt, we can see that Tesla has a debt-to-equity ratio of 214%. This might seem extremely high at first, but don't forget that Tesla is producing cars. And the average debt-to-equity ratio in the auto industry is actually 233%. In addition to this, Tesla's debt-to-equity ratio actually has been decreasing over time. If you're still scared about Tesla's high debt, just remember how many companies out there would love to purchase Tesla, specifically for their patents, technology, and also infrastructure. And I can't imagine the number of entities out there who would love to become an investor or creditor of Tesla. Tesla is simply a company who makes better products with little competition right now in an industry with a high barrier of entry, and that really tells you why a lot of people love buying the stock. However, the stock today is currently overvalued at a price of $810. This is pretty much near the high of the stock, and I wouldn't purchase the company just because of how the stock is traded. You should instead try to catch the company near its intrinsic value. The average intrinsic price by 31 analysts is around $637, and Finbox models predict an average price of $803. You should really try to purchase the stock around the low end of the valuation between $537 and $637. However, you can try to purchase the stock below $800 if you're okay with less gains and the goal of holding the stock for more than a year. I would keep your exposure to the stock between 10 to 20%, just because when you're investing in the stock, you're really investing for a greener planet and also a change in the auto industry. Tesla is really the future of automobiles, and the company has room to grow. The company has somehow managed to make electric cars desirable and also economical. The company currently has no real competition, and it's likely to take over the electric car industry. And this was pretty much a long shot 5 years ago. However, like Elon Musk said before, when something's important enough, you'll do it even when the odds are not in your favor. Thank you guys so much for watching, and make sure to drop a like or subscribe just because these videos take a ton of time to make. And also, make sure to leave a suggestion below too on really what company I should analyze next. And if you guys still here, I'll see you guys next time.